Good morning, everyone. Thanks so much for coming on a beautiful Saturday. I'm very excited about this weekend. It's a really fantastic group of companies, some of which I know very closely because they're in my portfolio and I follow them, some of which I'm interested to learn more about because I'm aware, but at this point in the market, there's so many stories to catch up on, it's hard to get to them all. So I'm really excited to have a chance to catch up with some of these stories that I don't necessarily know quite as well, because if they're on a list from one of my co-hosts here, another newsletter writer here, that alone means that they're worth a look. So I'm going to speak today and tomorrow. Today I want to talk about the golden argument, so why the bull market is back in gold. Tomorrow I'm going to speak more about how to position your portfolio to take best advantage of the bull market that's coming. So that's what kinds of companies to buy, what kinds of opportunities to look at, and to not limit yourself just to gold because there's a bigger picture movement at play here. So that's the play for these 2 days for me. Okay. So there's lots of ways you can argue about the world right now, about the global economic situation, about what's going on with the United States economy and the markets. And you can, and I'm sure many of you have spent many days arguing these points. But if you want to really simplify it, I say that there's sort of two paths that are potentially ahead of us right now. One of them is that things are okay. So global growth is okay. It's enough to stave off any kind of disaster. We continue to have sufficient accommodative monetary policies in Europe and Japan and in emerging markets to support stock markets. That global situation means that the United States does just fine. Their sluggish growth continues sort of as it is right now, and they can potentially continue to normalize. So that would be a rate hike in June. The other option is the darker side of things. So global growth does not work out that well. Central banks have no ammunition left to fight that slide, which is a nerve-wracking situation in itself. And then that would mean that in the United States, weakness wins and tightening is off the table. That's sort of the two broad paths that are ahead of us. I happen to think that number two is more likely, but what matters here is that it doesn't matter which it is, because both are good for gold. Number one is an inflationary environment, and of course gold is a hedge against inflation. Number two is a deflationary environment, and gold is a hedge against the results of deflation, which are primarily debt defaults, currency debasements, and equity losses. So broadly speaking, when you want to look at the issues that are facing us, it's comforting to know that gold works in both of those environments. Underlying that whole situation is uncertainty. There's a huge amount of uncertainty in the world right now. I've just put some of the questions up there that I think are sort of plaguing the environments these days. Is the bull market over? What will happen with oil? Is Donald Trump going to be president? What's going to happen with negative interest rates and all of this experimental monetary policy that we've experienced over the last few years? What is the Fed going to do if the economy turns south? Is the dollar's run over? There's a lot of uncertainty. And gold is the safe haven that people turn to in times of uncertainty, especially when it's undervalued. Now, we've just been through this massive bull market in America, and one of the only sectors that missed out on that run was gold and miners. So when you have all of these American investors, global investors in general, who've done very well in the markets for quite a few years, they're now looking at a market that's overvalued. They're now looking at a lot more risk in those sorts of investments. So what they want is security, something with less risk, and value. A lot of the things that they have are overvalued, so they want something that's undervalued. Gold works for all of that. Now, we had a great run for gold in January and February. What I like even more is that gold has now held its ground for 2+ months. It has consolidated those gains, which provides a foundation for another step up. Another step would require a bit of a catalyst. Thankfully, I think there's a lot of options out there to provide that catalyst. So I've listed them there in red, but I'm going to go through them now, sort of point by point. So no US rate hike. That would certainly be one catalyst for gold. Is it going to happen? I have no idea anymore. I used to have an opinion. I've given up having an opinion about US rate hikes. In her last statement, Yellen was as utterly balanced as she could possibly be, so you basically could take nothing from it. Certainly election timing matters. She certainly does not want to be pinned as the cause of any kind of market downturn, let alone recession. So that's a factor. At the same time, she certainly wants to create a bit of a comfort zone so she could cut rates if things go south. These are all the arguments everybody's talking about. I don't know what's going to happen, but like I said, for the gold argument, I don't think it matters, which is great. Either way, though, it could be a stimulus. In terms of global stimulus, Japan is now trying to no longer provide additional stimulus. We'll see if that works. The EU is facing a good number of challenges continually. More stimulus in the EU is definitely possible. Again, another possible catalyst for a move in gold. Going down the list here, the US economy. I see a very weak US economy. So GDP in Q1 expanded at 0.5%, which is the slowest pace in 2 years. Taking a slightly bigger look, 2015 was slower than 2014. The recovery is not gaining momentum. It is slowing. There's a lot of data points that we could use to feed that argument. Some of them are things like industrial output has now been down for 7 straight months year over year. And there's lots of people who say that industrial or manufacturing numbers don't matter because America is such a retail economy. I don't believe that. I think the overflow or the spin-out effects from manufacturing and industry in America are essential to that economy. The labor market, the Fed loves to talk about the strength of the US labor market, and there are some good numbers, but there's a lot of cracks as well. For example, temporary help, those are the workers who are usually the first to be laid off when things get tight, and guess what? Temporary help numbers are now declining. Manufacturing jobs just continue to disappear. That's what that chart is. And when you have an economy that is so dependent on consumer buying, jobs that are just service-oriented are not sufficient to support that economy. And then more globally, there are a lot of concerns about economic strength. These events within that weak economic context could provide the catalyst for gold. I mentioned a little bit about the US markets, and I'll say it again. I think the US markets are stretched by most metrics that you can look at. So some of the evidence that the fun in America is over and in US markets is over. Corporate earnings peaked a year ago and have been declining ever since. We have very high metrics for things like price to sales, debt to earnings, things like that. Share buybacks were really fundamental to that US bull market, and those are declining quite significantly. So year to date, we're only right now at about half the investment in share buybacks that we were at this point last year. That financial engineering was a very significant fuel to the US run. So if companies are worried about debt and capital resources, they're not putting that money into share buybacks, which is reducing a bunch of the fuel behind that market. Excuse me. And then you have things like after-tax profits having now fallen for 8 quarters. The US basically always goes into a recession when after-tax profits fall for 8 quarters. Again, another set of stimulus that could move gold. The US dollar, another topic of much argument. I see it being topped out primarily just from the basic perspective that the US economy is no longer the global outperformer, and the US dollar is no longer the global outperformer. And because of the feedback that a strong dollar has had on the US economy. We know that the dollar no longer going higher certainly helps gold. There's the fundamental aspect that gold is priced in US dollars. And then there's the fact that the dollar has been the other safe haven that has been in play while gold was being ignored for 5 years. But if the US dollar stops moving up, gold takes the place as the safe haven. So savers need somewhere else to put their money. And that's what I think is really the biggest argument behind gold right now, is investors rotating into the sector. So I've said it before, but it's worth saying again. The huge number, especially of American investors, which are a very significant force, they have spent the last 6 years in US equities, and for good reason. It was low risk and it was reliable returns. If those days are over, those investors need somewhere else to put their money, and they need And in that search, they're looking for security, so less risk of being in equities that are about to turn down, and value. US equities are very overvalued. They're looking for something that missed the bull run. Not very many things missed the bull run. Gold and miners certainly did. So an example of how that is already playing out, the World Gold Council put out some results just this week about gold demand in the first quarter. So in Q1, we had 1,290 tons of gold demand, which is a very high number relative. But what really matters is that investment demand was up so significantly. That was the real driver behind the gold demand in the first quarter. ETFs alone bought 364 tons of gold worth almost $14 billion in that quarter. And that more than reversed the ETF outflows of the 2 previous years. We haven't quite reversed the outflows from 2013 yet, but maybe we'll get there. So that kind of rotation into gold really matters. The other aspect that I think, another aspect to that argument that I think is really worth considering is the what happens next argument. So markets are overvalued, great. Investors are looking for somewhere else to go, perhaps. If the markets were to turn down, what do investors generally do when the markets turn down? They want to hedge for their stocks, right? They may still believe in some of their stocks, or they may want to just hedge their positions generally. What the usual move there is to move into bonds, right? So when the economy weakens, the central bank can cut rates, that supports bond prices, and so that's the natural hedge. But you can't cut rates when they're already at zero, or essentially zero. So bonds cannot provide the hedge that they usually do in this scenario. That's just another way of looking at the argument and coming to the conclusion that gold is the go-to response to all of these potential weaknesses, downturns, and uncertainties. John Hathaway did some basic calculations for what this investor rotation into gold might look like in terms of numbers. So if investors increase their allocation, their portfolio allocation to gold from 0.5% that it's at right now to 1.5%. So in the scheme of a portfolio, that's not too dramatic. That would represent an absolutely overwhelming 55,000 or 56,000 tons of gold demand, right? 1%, that's more gold than is available in London vaults to buy by a lot. In fact, only increasing demand by 0.1% would swamp that supply. So it's this accumulation of arguments that to me really gives me a lot of confidence that we're looking at a good run for gold ahead. How will that run actually happen? Wish I could tell you. I wish I had a crystal ball. I do not. We can look at recent history for some examples. So when we had our 2002-2003 bull market beginning, that had a great run in 2002, and then there was a significant setback. Gold lost 30%, I think. It was quite sharp. It was very nerve-wracking for investors who had just been through a really bad bull market and were very scared that they were back there. And then it took a while for these things to consolidate and move up again. So that's one way that this sort of thing can happen. Another way would be what happened in 2009, which is that there basically wasn't a pullback. 15% was about as much as you got. If you waited for a larger pullback than that, you didn't get it, and you missed the boat, and things went without you. I don't know which it's going to be. What I do know is that there are certain factors that influence gold's ascent regardless of sort of that big picture trajectory. Seasonality certainly plays a role. Gold always slides going into June. Sure, yes, you can argue that when a bull market is beginning, some of these trends get bucked, but in general, gold slides into June. So that's one of the reasons that I'm in a bit of a rush to add new gold positions to the portfolio right now, because I think this is the last chance to position at this gold level before it moves, which I think will happen after June, largely based on seasonality and the Federal Reserve. And the Federal Reserve is why that seasonality is there. And of course, there's world events that we can't predict that will have impacts, and there's corrections. That's just natural part of a rising price, is that it pulls back at times. What I want to say right now, and especially leading into introducing some of these companies, and ahead of my talk tomorrow where I'm talking about what kinds of stocks you should include in your portfolio, is that it's very important to keep things in context right now. So this is Kinross. Absolutely, it's up 160% this year. Yeah, that's significant. I'd call that significant for sure. Is it tough to buy a stock when it's up 160%? Oh yeah, that's tough for sure. But then zoom out, right? So this is the 10-year stock for Kinross, which gives you a little bit of perspective on where the stock could still go. So we're in the first inning of a long game. It's hard to buy stocks when they're at their 52-week high, but I would venture to say that it would be harder yet to look back in a year or two and see that you still missed multiples because you weren't willing to buy at a 52-week high, right? So keeping things in context, I think, is really important at this stage in the game. Don't kick yourself if you didn't load up in December. It was a very long, hard bull market. It was very difficult to be convinced, no matter what data you were looking at, that things were about to change. So don't beat yourself up if you didn't buy in December. But keep things in context, given the moves that we've had so far, about where we could still be going. And part of where we could still be going that I really like to remember is that gold becomes a bit of a self-fulfilling prophecy when it starts to move. So the cyclicality of gold, excuse me, is quite well known. When it gets hot, investors rotate in, just in the way that I was describing, and they make a lot of money. And then when it starts to turn down, they rotate out somewhere else, and they ignore it for years while those in the industry sort of struggle along and try to make it to the next good phase. But then when it starts again, then those investors rotate back in. And because of that, gold momentum can feed itself. It's a bit of a self-fulfilling prophecy. So I'd say Friday is just one example of that. So on Friday, we had some pretty good retail sales numbers out of America. You can certainly argue that good retail sales numbers increases the chance that Yellen will raise rates next month, and that should be bad for gold, so gold should have declined. And it did for 2 hours. And then a whole bunch of people who believe more broadly in what is happening with gold right now saw that as an opportunity, bought and moved the price back up. That, I think, is an example of believers in gold creating this momentum that will feed itself and keep the market moving. And this, I don't think anyone in this room really needs to see. I'm sure you're quite familiar with this, but this is the venture exchange and the terrible nastiness that we have seen. I don't necessarily think that the venture exchange is going to be the best proxy for the health of the mining sector or even the exploration sector going forward, because there's a lot of companies that are inactive that are impacting that level. But nevertheless, whether or not the venture as an index regains the heights of 2007 or even 2011, the several hundred good companies within that group will do that, because that's what happens in this sector. And of course, we're not looking at an 80% gain, because regaining an 80% loss is a 400% gain. So context is really important. This context for the gains that are possible is based in some gold arguments that I think are strongly based in a macro environment that supports gold. And that's my story for today.